Hey everybody, Chris Englebert with Englebert Financial Advisers in Allentown, Pennsylvania. And guess what? It is the first of the month update for May 2024. This year has been flying by. Hey, we always start out with a cartoon, and what's on investors' minds? Well, will April showers bring May flowers? And there's a reason why we said that. Because if you look at this chart of the S&P 500, April 2024 was the first down month in 5 months for the S&P 500. Now, if you remember our first of the month update for April and February, we were talking about how our risk indicators are getting stretched. We were taking some positions off the table, raising cash, etc., in anticipation of some type of pullback. Lo and behold, we got it in April. Now, it was about a 5-6% pullback, depending upon the equity averages that you looked at. NASDAQ a little bit more, S&P a little bit less. But again, it was the first pullback in 5 months. Now, the real question is this the pause that refreshes? Or my personal belief is that we're going to chop around, trade back and forth, and it's going to be a very long summer. Now, there's also an adage out there that says sell in May and go away. And there's been numerous studies that show that if you liquidate your account, which we would not suggest, and then turn around and buy it back in October, you avoid the 4 or 5 worst months, which usually tend to be in the summertime. Now, again, I'm not looking for a big market pullback, but you can see that we had a garden variety 5%. Maybe we get a little reflex rally and maybe we end up down 10%. But again, our risk indicators are about midfield. We have a lot of cash for our clients, and we're looking for opportunities out there. Now, one of the opportunities that we see is in the bond market, because one of the reasons why the S&P 500 and some of the other major stock indexes sold off in the month of April is because we've seen interest rates float higher again. If you look over on the left side of your chart, you can see that the 10-year Treasury peaked around 5% back in October, November, when everybody was worried about Jerome Powell continuing to raise interest rates. Then in October, when Jerome Powell came out and said, hey, we're not raising short-term rates anymore, we saw a collapse in yield to the 10-year Treasury, finishing the year at 3.88%. Well, now look what's been happening. There's been a steady march upward as far as yields go, and we peaked right around the 4.7, 4.65% level. Now, again, we're not suspecting that there's going to be a recession this year. I am more confident that it will probably be a slowdown in the economy next year. And what happens is when you have a slowdown in the economy, interest rates come down. We still think that short-term interest rates are going to stay elevated for at least the next 9 months. And we think short-term bank CDs and T-bills still make a lot of sense, but we think you're being given an opportunity to, again, a fancy word, lengthen your duration. So if you're 100% in bank CDs right now, you may want to consider moving 5, 10, 15, 20% of your money to longer duration fixed income assets. There are a lot of exchange traded bond funds out there that have a very good yield, that have an average life of 3 years that we would suggest, or you may even go out about 5 years. We don't think you have to go out and buy a 10 or a 20-year duration bond portfolio, but we think you got to start increasing your duration, and you're being given a second chance because yields have backed up. Now, the other reasons why yields have backed up is because inflation is not dead. If you've watched some of our videos from, especially from the NASDAQ, and you can always see all of our videos on our website, englebert-fa.com. But we did a Trade Talks video a couple of weeks ago, and I talked about how I thought that this year was going to be the year of 5, 5, 5, 5. And what I mean by that is the S&P 500 does 5%, bonds do 5%, which would mean interest rates would come down slightly the back half of the year on the long end. Commodities do 5%, and cash do 5%. So there's a real mix as far as, and we don't think you have to take extra risk by leveraging up in the equity market in order to get good returns. But one of the points that we wanted to make is that some commodity fund ETFs, and we favor the broad commodity ETFs. For example, KMLM is an ETF, DBMF is an ETF. And you can see that as of 4:30, the VOO, which is a proxy for the S&P 500, is up 7.46% for the year, while KMLM, a broad commodity ETF, is up 7.36% for the year. Now, A lot of people are talking about inflation, and commodity funds continue to show that inflation is out there. And one of the comments that we want to make about inflation is that we believe that inflation is not dead yet, but you have to understand, we think that inflation doesn't go up 1 or 2% a year. We think what happens is that COVID sparked off a big boom in the inflation, and that we are now in a higher inflation environment, which is obviously very clear if you go to the grocery store or you buy anything, is that inflation is accelerated. So we think what happens is that inflation stays very muted for about a 10-year period of time. And I can make the case that from 2010 to 2020, inflation was very muted. Then all of a sudden, 2020, COVID kicked off a big boom in inflation, which we obviously think is here to stay. Now, inflation's not a bad thing. Obviously, if you're buying a lot of groceries and you're trying to buy a new house, it is. But for investors, the 1980s was a period of high interest rates, high inflation, and high energy prices, and it was one of the best decades for stocks out there. Well, lo and behold, we are in a high inflation, high interest rate, and high energy price situation, and we think that in an inflationary environment, both stocks and bonds do very well. So again, to sum it up for the first of the month update, April was the first month in 5 that the S&P 500 and many of the other equity indexes pulled back. The lack of the Fed funds rate cuts and fears of inflation caused the 10-year Treasury to float back up. We think that this is a very good opportunity to extend duration, lock in some yields on these longer-term bonds. Because one of the biggest risks out there, if you remember, at the beginning of this year, everybody said, oh, there's going to be at least 200 basis points or 2% of Fed rate cuts. We're going to go from a Fed funds rate of 5.25 to 5.5 to 3.25 to 3.5. That did not happen. Short-term interest rates have stayed higher, and we think they stay higher through the end of the year. But again, next year, if the economy slows down and the Fed begins to lower short-term interest rates, those 5.35% bank CDs that you're getting right now for 3 months, next year could be 4%. And if you didn't lengthen your duration and buy some longer-term bonds, you're going to have what they call reinvestment risk, because obviously reinvesting in a shorter-term bank CD is going to be at a lower rate, possibly next year. Again, commodity funds are showing inflation's not over yet. We think that you have to have some exposure to some of these commodity funds going forward, because again, we think that going forward from 2024 to probably 2030, we're going to be in a higher inflationary environment, and stocks and real estate do very well. But having a little bit of commodity funds in there also helps to your overall yield, because they don't trade and they don't go up at the same time or down at the same time. So that's all we have for the first of the month update for May. We'll be back for the first of the month in June. We'll talk to you soon. Take care.